Hi everyone. Good morning, good evening, good night. If you're watching this video in any time zone, I'm back with one of the videos which I thought I will share with you, which is very informational and not probably 80% of the traders or 75% of the traders or people who invest in the markets know about this tool. And this is very important tool given the current situation where we are trying to predict the probabilities of hikes in the interest rates and what is going to happen next, right? So this tool is called the CME FedWatch tool. CME is the Chicago Mercantile Exchange. It is based out of Chicago, and it has one of the tools which tracks the interest rate hike probabilities by Fed, which means that if we want to know what is the probability that the Fed is going to raise or not raise interest rate hikes, maybe ease or not ease the interest rates, maybe start cutting down the interest rates in the upcoming meetings. This is the place where you should come in and see the probabilities of interest rate hikes, the probabilities of interest rate cuts, or leaving the interest rate as it is. So on my screen, I am on the cmegroup.com. If you can type in on your web browser, you can reach out to this website where you will find the FedWatch tool on the left side. You can see the name of the tool is FedWatch. Now, what information does it give? Why is it important for us to get concerned about the interest rates in the market, and how does it work out? So let me tell you, in the periods wherever the interest rates are increasing, which means that inflation is increasing. It means that the companies, the businesses, small or medium or big, the interest rate on the loan or the interest rates on the money that they borrow from the banks is higher, right? So which is kind of contractual activity. If the rates are high, lesser companies will borrow from the banks, less people will spend more money, less people will take loans from the banks because the interest rates being higher, the interest rate component of the EMI that they are paying to the bank will be higher, right? So if you understand in that way, if the interest rates are higher, you are going to make more payments towards the interest for a particular loan installment, which is monthly, and you are going to pay more to the bank compared to a scenario where interest rates are lower, where the interest rate component of that particular equally monthly installments will be lower, right? So in the higher interest rate environments where interest rates are high, uh, I probably think that it discourages companies and retail people and normal people to take loans, which is kind of a contractual activity in the economy, which means that the economy will not grow further because there is less flow of money in the market, or less the people are borrowing from the banks. Banks are not doing a good business and everything is expensive. Inflation is very high, right? So in that scenario, markets tend to not go up because of the reasons I mentioned. I mean, if if the interest rates are lower, more and more people will go and take loans from the banks for their needs. More and more companies would diversify, they would invest by borrowing loans from the banks. They would try to expand their business at a lower interest rate because then that interest rate component will be low. So in an environment where the interest rates are low, it is encouraging for the economy to grow, and it could be an expanding economy scenario where everybody wants to grow. They want to take or borrow more at lower interest rates for the benefit, whatever objective they have in the life, right? Now, looking at this tool, and let me tell you one funda which clearly works for all the markets, irrespective of US or non-US markets. If interest rates are rising, markets do not like it because then they think that the central bank, the Federal Reserve here in the US, is going to tighten the inflation. It is going to put more restrictions so that people do less activity in terms of cautioning, in terms of capturing the inflation, right? At some level, they will try to raise interest rates, right? So they will try to reduce the activity in the economy. The Fed will try to temporarily put a contractual cycle on the economy so that the interest in the inflation comes down. So when central bank increases the interest rates, Nobody likes it in the market, and the markets will go down. The only point when the markets will start shooting up is when the Federal Reserve will start cutting the interest rate, which is also called as easing the interest rates, as you can see. Now, let us look at a few examples for the upcoming meeting, which is tomorrow with the Federal Reserve. Yeah, so the Fed Reserve meets every month. The frequency depends on how soon they want to review the inflation data, the jobs data which is coming out, how the economy is performing, whether the inflation is in control. So you can see the number of meetings that they have and the dates. So the most recent meeting is the coming up tomorrow on November 1st, and Fed is going to decide whether they want to raise the interest rates further, or they want to ease it, or they want to leave it normal, right? So if I select November 1st, which is the tomorrow's meeting for the central bank in the US, you will see currently the interest rates are 525 to 550 BPS, which is the basis points, which means that in the current rate, if the banks want to borrow from the central bank, they want to pay the central bank 5.25 to 5.5 percentage of interest on the money that they are borrowing from the central bank. And then if you know, when banks borrow from central bank and they when the banks lend it to you for your car loan or credit cards or whatever, they make their own margin. And that's the reason you might see the interest rate on the home or mortgage is 8 or 9 or 7.5. On the credit cards is 22.5 or something. So that is the margin that the banks are making out of it, right? Now, on this chart, you will see the probabilities, and these are the probabilities of what is going to happen tomorrow in the Fed meeting. And 98.2% is the highest probability that the Fed is going to leave the interest rates as it is, which is 525 to 550. There is a 0% chance that the Fed is going to increase the interest rates, and 1.8% chance that the Fed is going to decrease the interest rates. Now, in most of the meetings, in most of the scenarios, if we look at this tool, you will get some idea of what is going to happen in the next Fed meeting. So tomorrow, probably when 2 p.m. or 2:30 p.m. EDT time, when Mr. Jerome Powell, our chairperson for the Federal Reserve in the US, when he starts speaking, you will see the markets either react negatively or positively. But I think if the decision for the Fed tomorrow is not going to raise interest rates any further, that is also not a good news for the markets, because markets want lower interest rates. Hedge fund managers, the big institutions and clients, they want to see the interest rates decreasing. They want to see the Fed making a decision to cut interest rates. And that's the reason where economy will expand, as I explained to you earlier. And that's where the markets will grow. They will shoot up. That's where we will see more investments from other countries, the emerging economies, into the US, right? So for tomorrow's meeting, if there is no change in the interest rate and if Fed leaves it as it is, I don't think there is a bullish scenario for tomorrow. Uh, I let me tell you this. I think I have one of the other videos which I posted on my channel regarding the Fed trade, the Federal Reserve trade that you can take. So tomorrow, if by any chance, uh, between 2:30 to 3 p.m. or 3:30, if you see the markets are making new highs, if you see the SPX, which is the mother index, or the SPY, which is the ETF on that mother index, if they are going to make new highs tomorrow during that period or the time frame when our chairperson of the Fed is speaking, I would take a short position and I would buy a put a spread at the money if the market is making a new high, or I would go out 30 or 45 days and buy a put at the money and wait for the next few weeks to see the results, right? Or maybe in the next 2 days. Now, if you don't want to take too much risk, the puts for SPY or SPX are expensive for 30 or 45 days out of expiry. You can take for the current week, you can take a put, or maybe you can take 10 days expiry put for SPY, which is cheaper at the money if the market starts making higher highs, right? During the time when Fed chair is speaking between 2:30 to 3:30 p.m., you can take a short trade there by either doing a put spread at the money, or you can directly buy a put at the money. And you will see in the next few days when actually the Fed minutes meeting from the meeting come out, when actually the traders, the big investors and the hedge fund managers, they start seeing what actually Fed's strategies, they will start selling off. And I think this is going to happen again. Let's see how the market behaves tomorrow. We will see the markets rolling down for the next few days or weeks after the Fed meeting. But let's see. There is another hint that we got recently. Probably some of the information is already captured in. We have seen markets rolling down from the last few days, and that is not a good sign for what is going to happen tomorrow. So that is my trade idea on Fed. But again, if you want to look at the different dates, if you go out to 13th of December Fed meeting, that's where we are saying that Fed is probably going to ease the interest rates, start easing. There is a 74% chance that the Fed will start. Oh no, it is the same. So 74% of the chance the Fed is going to keep the interest rate same for December 13th. It is 25% of the chance that the Fed is going to increase the interest rate by 50 basis point, a 1.4% chance that it is going to cut. Now let us look at the probabilities. If I click on probabilities, and it is giving you the meeting dates for the Fed from tomorrow until December 2024, you will see whatever probabilities you see in blue are the highest for that particular time frame or date. So if you want to see when we can start the Fed to start cutting rates is somewhere in June 2024, and I see more probabilities in September 2024 or in December 2024. So I think until May or June next year, do not expect that the Fed is going to cut interest rates. There is no easing in the markets. The stock markets will be very volatile. They might move in the same range or at least not go up is what I think. But we can take some of the trades for each of these Fed meetings depending on when the Fed starts cutting, right? So have a look at this, and it gives you some idea of what is the probability that the Fed is trying to go to this interest rate range uh, compared to what we are today. So it might cut, let's say 100 basis points by December. It might cut by 75 basis points by November next year. But that is what we see. And again, it is economical data. Nobody can guarantee it. It is just playing out the probabilities. I have already, and I have always told you, investments and trading are just logics and your mathematical probabilities and the formulas. If you know them, you can make a guess, you can ballpark it. Nobody actually knows where the markets are going to go in a year or two because there are several factors impacting us, impacting the market, and you cannot even predict where we are going to go. But that is what I found on the FedWatch tool. So I hope you enjoyed this video. If you enjoyed, subscribe to my channel, like my channel, and I would keep posting more videos soon. Thank you so much.